There you have it, today's closing bell from the New York Stock Exchange.
Let's take a look at the big board and see where the numbers landed here at the end of the day. The Dow Jones, they're in the red, more than 430 points. A similar picture for the S&P 500 and NASDAQ. They both closing the day in the red. The S&P is down more than 1% and the NASDAQ is down about 1.5%.
Nancy Davis joins us now with more. She's a founder and chief investment officer at Quadratic Capital Management. Hey there, Nancy. So tell us, what was driving the market today?
Well, the market does not like more rate hikes. We've had enough. Protest. So definitely those comments today were not well received. I think the Fed, a little perspective, if we think about, February 16th, if we were back 12 months ago, the Fed hadn't started hiking rates yet. They've starting in March, they hiked 450 basis points. So having more talks of a 50 basis point hike at one meeting is pretty alarming to us all.
And we also had January's producer price index coming in. It was hotter than expected. How does that factor into this inflation expectation, right? And future rate hikes?
Well, Powell said in the last press conference 15 times that disinflation was being priced into markets. And I was applauding him. I was like, finally, he's acknowledging the facts, is that inflation protected bonds fell tremendously last year. Even though realized inflation was at a 40-year high, future inflation expectations have been pricing in this very disinflationary outcome. So I think what that means for your audience, for viewers, for investors out there, is it's actually a pretty decent time to buy some inflation protection or inflation-linked assets in your portfolio, because the markets are pricing in that the Fed hiking policy rates is going to ease future inflation expectations. So it's kind of a bizarre world, even though realized, the last CPI print was 6.4. Just the implied CPI going out 1 year is around 3, and out 5 years it's around 2.3. So it's really below where realized has been.
Yeah, it is a bizarre world. Let's talk about the number of first-time jobless claims, because they continued to edge lower last week. Usually, as I've said before, that's something to be celebrated. When it comes to the Fed, though, that's something that may make them continue to drive up their interest rate hikes. What do you see?
Well, the Fed can't control the participation rate. I think the problem is that we have some states out there that are sending, inflation relief checks in the mail to help combat the higher prices that people are experiencing in their everyday lives. I think that's a very well-meaning policy, but we have to think about the second-order impacts about what that's to do to the labor market, and is that the right, maybe it's a short-term relief, but it could cause longer issues longer. So I think it's really time, investors really need to be prepared for any different outcome in the portfolio. And I think inflation-linked securities are a really good buy, because the market has priced in disinflation. So whether the Fed hikes, another 50 basis points, another 25 basis points, I personally don't think it really matters, because I think at the end of the day, inflation is that thief in the night. And no matter what industry you're in, no matter what type of savings you have, I think it's prudent to have some piece of your portfolio be inflation-linked assets, because why not? It's priced for disinflation, as Powell said.
All right. Nancy Davis, thank you.
Thank you.